Welcome back to the second episode of P2P Unscripted, where myself, Jakub from P2P Empire and
Denny from Rethink Peer-to-Peer
will be covering some of the latest developments from the industry. Today, we'll be answering the question whether investments in P2P lending are still safe in the current market environment. We'll be also covering the Nera Capital case on Mintos, as well as some of the latest events that may be relevant to you if you're investing in P2P loans. All right, so let's get started with the first topic. Some investors are naturally worried whether the current energy crisis, the high inflation, are somehow impacting the P2P loans that investors are investing in. So perhaps, Denny, we can start with you giving us your opinion on the current market environment and whether you are changing your investment strategies.
I understand the concerns investors have, given the volatile market developments. But to be honest, I don't see this kind of energy crisis as something that is drastically changing the market dynamics, for me at least for now. I see it rather as an as a kind of an ongoing turmoil that we have in the market that for me basically started off since, let's say, 2020, since the COVID pandemic. We have seen the war in Ukraine unfold, and then consequently also the high inflation that we have witnessed for many years to come. Now it's kind of like the energy crisis. Let's say if we look at the borrower segment, the consumer credit market, there is a persistent and ongoing stress for them, which could affect then loan book performance and could lead to a deteriorating loan book performance for some lenders. I'm currently not adjusting my strategy to any capacity or to any extent. We can discuss about potential ways of how to maybe prevent certain scenarios in the peer-to-peer market to unfold negatively for the investment portfolios of investors. But maybe we before we get there, you can give your take on if you are adjusting your strategy at the time being and how you look at the overall economy development.
Yeah, I also understand the fear that some investors may have. Like you mentioned, we went through COVID, we went through the war in Ukraine. So at some point, you kind of build some sort of resilience towards the news. And we have also seen what has happened, so we kind of know what to expect. When I was talking with some of the platforms, they told me that COVID and the Ukraine war was way worse in terms of changes to their lending operations. I would say they had to react in a more drastic way than with the current market environment and the energy crisis. So yeah, I'm not too stressed about it, but there are definitely some things that maybe investors who have not lived through those phases should be paying attention to. Obviously, any macro change will impact some borrower segments. Here in this situation, we can probably mention emerging markets, low-income borrowers will be affected worst by the current market environment. So if investors would like to decrease risk, they can decrease their exposure or avoid exposure into newly launched loan originators from emerging markets who are lending money at high interest rates, short-term borrowing, where maybe the track record is not as extensive yet to justify investments into those loan books.
Yeah, makes sense. For me, basically, it's observing what has happened in the past 5-6 years, which lending segments have struggled. How did specific platforms, but especially the loan originators, how did they tackle those kind of obstacles and those kind of crisis situations? And what we saw is that it was mostly turning out into, let's say, more of a liquidity crisis because everybody was pulling out their funds from the platforms. Ultimately, it was the lack of liquidity that I would say imposed the most stress towards platforms, because naturally it also uncovers platforms that haven't been doing very well in the past with their lending business, with their lending operations. And I feel like this is where the history kind of can repeat itself. We see that a lot of money is flowing into new businesses, into complex business models that have yet proven to be profitable, sustainable. Maybe there's no access in terms of NPL data, recovery performance. So there's a huge unknown, I would say maybe a black spot where you can't really assess how they would perform and if maybe they're just surviving for years because a lot of funds have been throwing onto bad debt. And then as soon as the new funds are stopped flowing behind those business models, you will kind of see that they might face some issues then repaying their obligations towards investors. So that's kind of what I look at or how I see the market, and that liquidity might impose the biggest risk and the biggest threat when it comes for lenders to refinance themselves or to continue with repaying debt. So that's probably the biggest threat that I would currently try to look at. And how you can avoid it, just like from what I said, look at the financials, profitable, sustainable business models, understanding also how their loan book performance. And then I think you're good off, combined with the historic data that you have, the track record, as you mentioned as well. Those might be the platforms or the lenders that are better off trusting in this current market environment.
So basically, risk management maintenance during whatever economic environment, not just during higher uncertainty. This is nothing new specifically for 2026. It's just being aware in what you're investing, what you're funding, how those funds are being used, and what can go wrong if the marketing claims from some of the platforms don't pan out as good as they're being promoted.
How do you see, maybe we can tackle also one of the questions that I saw in the community tab in terms of how well Baltic platforms are prepared for a possible conflict then from Russia. Do you have a take on this?
With me being exposed in some of the Baltic platforms, obviously I thought about it, right? And I would not say that I'm too confident about potential protocols and scenarios where the platform operators would magically transport themselves somewhere to the south of Europe. I think that by the very least, if something would have happened, investors really need to expect delays when it comes to processing of funds, repayments, etc. I know of a few platforms that I talked to that they have made some sort of tests where they were trying to operate from different country. I mean, obviously, all the platforms, they can operate remotely, right? For most of them, at least. So if let's say Baltics were invaded, I don't know to which extent people will be able to leave the country. What we have seen in Ukraine, there was martial law, so people could not leave, or just certain groups of people could not leave. Then additionally, any money transfers out of Ukraine were not possible anymore. So we can see some sort of cash not being able to be transferred to the investor accounts. And then I heard some platforms saying, "Oh, we have a second bank account prepared for scenarios like this." I think the bigger risks lie for platforms where you are funding assets that are situated in the Baltics. So, for example, real estate, land, that kind of stuff. Yeah, maybe even like lending portfolios, consumer lending portfolios. So I think that the default risk is bigger than compared to assets being funded somewhere else in Europe. So I think that's something that people should closer pay attention to when it comes to exposure, as this will be more complicated in my opinion, because if courts don't work properly, then the recovery of assets will be very long and uncertain. So I think that that's something investors should pay attention to. Yeah, what's your take on this? Do you have any other opinions?
No, I would largely agree with you. Personally, when I kind of followed the war happenings in Ukraine to a limited extent, I had to pay the price. When I look at my portfolio, I was then exposed to, or my funds have been locked up with Peerberry, with Twino, with Debitum. So it was definitely a learning curve to not underestimate geopolitical risks. In terms of what you said, I would largely agree as well that obviously land properties that are located in the Baltics might be a bigger risk factor for investors to consider. Operational execution, working remotely, having your servers abroad, having your IT infrastructure, and also maybe the lending companies that you work with abroad. So that's probably more of a less accurate threat for investors. I mean, geographical diversification from that sense, it can be considered a sensible hedge to avoid those kind of scenarios.
When you said you had some lessons from Peerberry, Twino, and Debitum. I know Peerberry, they managed to repay everything back within 1.5 years. We did not get the interest, but at least the principal was repaid. So that's, I think, positive. What was the outcome with Debitum and Twino from your end? Did you manage to retrieve anything or no?
So with Twino, the case, obviously their funds have been locked up from the Russian side, and they were just able to gradually repay around 100,000 euro each month according to what they were able to transfer out of Russia. They progressed pretty nicely throughout those years. Obviously, it's not the desired scenario that you want to see as an investor. They have picked up the pace now lately since the mother companies Fino of Twino was offering some early repayments then for investors in exchange for some discount. I didn't partake in this kind of repurchase proposal that they offered. I think they offered now even the second one following afterwards to just get rid of the story and finish this chapter. And for me, kind of like I was benefiting from a lot of investors, wanting to cut their losses short and just say like, I want to have my money back as far as I can now immediately, which I think now the remaining portfolio is around 600,000 euro, which is the equivalent of, let's say, maybe another 5 installments. So I think by the end of the year, I should have restored my investments, no losses, while keeping then also the interest payment throughout the entire period. And then at the Debitum story, now they restructured the debt, and there was also some discussions. I think like the legal structures have been adjusted a bit and who is like owning the claims. But then force majeure was the argumentation that they couldn't repay the funds early. I think it's roughly 2 million euros that we're talking about. From my understanding, they're still operational, so they are still in business, but for some reason not accessible to investors. There have been some discussions in the meantime if there's a potential buyer of those claims to basically take over the claims and would, for whatever discount, repay investors early, but hasn't materialized. So there's no need to talk about it. I'm affected with a rather small investment. I think it's 250 or 300 euro, but still.
Yeah. Well, at least it gives us some sort of an idea of what could happen if things go south, right? Okay, so let's talk about the second topic, Nera Capital case on Mintos. Yeah, to be honest, when we got the question, we were not exposed, so we will probably not be able to tell so much about it, but perhaps we can give our thoughts on what's happening. Okay, so basically on Mintos, there's this lender, Nera Capital, and they are lending money to law firms. Those law firms, they are dealing with consumer claim cases. They are so-called no-win, no-fee cases where they borrow money from Nera Capital to be able to fund the cases 2 or 3 years while hoping that they will recover them, repay the loans, the interest, and then pocket the profits. The regulator in the UK is currently reviewing those law firms for practices that may put the clients in danger. They are questioning the solvency of those law firms. And based on that, the law firms stopped paying interest to Nera Capital, and hence Nera Capital stopped paying interest to investors on Mintos. So that's been the news for about a month or two months now. Yesterday, there was an update from Mintos saying that as of right now, it seems that the repayment of the principal, which is due in a couple of weeks, for the first loans is also most likely going to be delayed. The exposure on Mintos is currently 61 million euro to Nera Capital, which is a substantial part of their loan portfolio. The investors are now wondering what's going to happen with their funds, what they can do, basically. So perhaps you can give your opinion on this.
Yeah, maybe just like for clarity, because I also was cross-reading a couple of information on this case, since I'm not following or monitoring Nera Capital too closely, to be honest. But what I found was there's some contradicting information in terms of like if this is a sector-wide investigation that would affect all kind of underlying law firms, or is it something specifically for that targets, let's say, the law firms that Nera Capital is financing? Because from my understanding, Nera Capital framed it a bit like it's a sector-wide investigation, whereas we have seen other lenders, other litigation finance companies such as Sandfield Capital that are on Income Marketplace that claimed there would be basically no impact for them and especially the law firms that they are working with and that they finance. So I don't know if you have found additional information in terms of like, is that something Nera Capital specifically, or how global is this kind of regulatory disruption right now?
Yeah, I've read the statement from Sandfield Capital, and they were kind of pointing towards this does not affect us. It affects mostly just Nera Capital and the law firms that they are working with. So the framing from Mintos think that, It affects 80 law firms. It's a sector-wide kind of regulatory review. It's questionable maybe, but I'm no expert in litigation financing in the UK, so I cannot really evaluate it. I've read an article from the regulator, and it seems that based on what they are saying, I don't think that this will be resolved anytime soon. So investors will probably need to be a bit more patient. Obviously, 61 million exposure to litigation financing lender in the UK, who is, I think they're based in Ireland, funding UK portfolios. Yeah. Yeah, hard to say, to be honest.
So there's obviously one-sided answer that could apply for this case. I would say, because you asked me what would be my take on it, as you said, 60 or 61 million outstanding on Mintos currently. It would be a huge blow for the marketplace. It would translate to the biggest lender default, I think, in the history of the marketplace.
Sorry, that would happen if the regulator says those law firms, they are basically insolvent. They don't have enough capital to cover their debts, and they engage in a aggressive acquisition of consumer claims in the UK. That would be the worst case scenario, where they would not be able to pay back the debt, right, and close down the business. And yeah, that would be a big blow for investors on Mintos for sure.
I mean, what investors can hold on to for the time being, I haven't received or read this official Mintos communication that you mentioned, so I haven't looked at it or haven't seen it. Obviously, I think what investors can hold on to right now is Mintos hasn't officially changed the status in terms of Nera Capital towards it's a suspended lender or it's a defaulted lender. Let's hope for the best, that it might be a minor regulatory disruption and eventually the things will unfold or turn out for the good. But yeah, if it's not the case, obviously just giving the sheer size, I think 60 million, that would translate maybe to around 8%-10% of the total portfolio of Mintos, which considering its size, is a significant portion. Would show once again, that the risk control by Mintos is something, investors can't really rely on. You're better off making up your own choices, your own lender evaluations, and see where you can kind of assess the business model, the performance, and everything. That's for me let's say, turning away from Mintos, but more towards the investor's perspective. For me, litigation financing, I have a broad understanding what this is all about. It involves funding third-party lawsuits in exchange for a share of the settlement. And I'm wondering, like, with complex business models, not just litigation financing, but overall, how do investors look at asset classes that are from their nature a bit more complex, that are harder to assess, to value, to evaluate, to monitor? From my understanding, there is no underlying physical collateral, let's say with real estate, for example. I'm just wondering how many investors actually understand what they are investing in, and are they aware in the first place about the risk that they are taking by going into those kind of assets, complex structures that are very hard to assess, to monitor. That's something that also investors on a critical side have to ask themselves.
You pointed it out already a little bit. I think a lot of investors, they look at cashback marketing communication from those lenders or from marketplaces, in particular Mintos. And this is not the first case. We've had this before, a couple of years ago, and most of their funds in recovery happened. And it was a similar story also. The marketplace promotes the lender with a higher cashback, then investors pile in their money, and then something goes wrong. So it's not something like a rare event. But you're right. Those complex business cases, investors can barely evaluate the risk. So mostly they're looking at the reward that comes in, and if they are too exposed to it, they will pay the price. So that's unfortunate. At the same time, I think investors need to realize that Mintos is a passive marketplace or multi-asset platform these days. Sure, they fund there is some sort of overlap with shareholders for some companies, some lending companies, but overall, with their business model as of right now, I cannot even imagine that they could be doing some sort of enhanced due diligence, risk monitoring of various regulators for various products in multiple markets at once. I don't see how that could work. I think based on their last financial report, they are not even profitable after how many years of operation? 11. I don't think that they even have the resources for it. Sure, you have those Mintos risk scores, but they can change based on latest developments, so that's also not a guarantee for safety. Yeah, investors on Mintos, they need to do their own homework and look beyond the marketing communication, in my personal opinion.
Yeah. Yeah, and I think when that's maybe the last information that I can contribute, I also picked up that the Mintos risk score for Nera Capital in particular was around 7.6, 7.1. I'm not sure. But let's say on the broader scheme, let's say a total risk score that is more, let's say, that points more towards a better investment opportunity. Obviously, they break it down with, different subcategories that they have in terms of like repayment strength or financial stability whatsoever. But overall, it was kind of like indicating a rather safe investment. But, I agree. You pointed it out very, very nicely that, giving the nature of the business, how can you observe a certain regulatory threat, a regulatory disruption in payments with so many, with global exposure that they have across all over the world, with so many different regulatory entities. I mean, to be fair, the UK regulator, it's not the FCA, there's like a different regulatory unit that is here now in charge, but overall, let's say the UK tends to, in the past has always been a bit more expressive in terms of protecting consumer rights and being a bit more active rather than other regulators from different countries. But it's hard to blame Mintos in the sense that, you shouldn't expect them to do the whole due diligence, the whole homework. You as an investor have to have also some accountability in terms of which risks you're exposed yourself to, and try not to be driven too much by, let's say, the marketing agenda that those platforms and companies pursue.
Yeah. Some investors also think that they could raise complaints to the regulator in Latvia in regards to Mintos, its monitoring efforts. In my personal view, I think this will not yield anything from what we have seen so far. I don't think that there would be any action from the Latvian regulator. And also, all the risks are explained in the prospectus, which most people don't read anyway. But I think for retail investors, to be honest, I've read a few prospectus documents myself, and I think that's by far one of the best things that happened with regulated platforms, because it discloses so many things that can go wrong. And this is not something you will find in their blog posts. This is only something you can find in a 70 page document on the platform, which you can nowadays summarize pretty easily to point out the key risks. I think this is something that serious investors should be actually looking into.
I agree. Yeah, it's obviously one of the beauties that came along with regulation, those kind of prospectuses. And I think at least with the assistance of AI infrastructure, you're able, like, without going through everything, word by word yourself, you can easily get an idea of, where the biggest underlying risks are located, how you are protected in whatever case may be. So,
most of the
pretty
time
much in line with you.
You will find out that you're not protected. Okay, let's move on. When talking about protection and risks, last time we spoke in end of December with the first episode. We were talking about Debitum, and now 5 months have passed. So has your opinion on Debitum changed during that time?
The rhetorical question now. Now, obviously, it's look, it was interesting to see the investigation that was then publicly accessible. There's like some, claims about like who came up with it first. Was it picked up from an anonymous source, or did Carsten, the blogger that then ultimately published everything on a bigger scale, on a bigger platform, a bigger stage? Or was it all due to his efforts and research capabilities? I think no matter, or it doesn't change really the discussion that we have surrounding Debitum and LFDF right now. Obviously, my perception or my opinion has changed in that regard, that I see now an elevated risk profile with LFDF investments, which is why I have currently paused my investments with them. I have very detailed analysis on the platform now on my blog that can be read through if investors are interested. So I don't know if it's needed now to repeat everything now, but maybe to highlight a couple points, and you can share your perspective as well. Honestly, for me, when you're investing in a fund like this and they have, like, let's say, more complex structures, and after time you're getting more aware of what actually is happening maybe in the background, you're more sensitive towards those kind of information, and it's up to you whether you consider like your trust is over everything and you're just like everything has always been well off, and I kind of continue on that trajectory, or if you're able to also maybe admit, maybe I have been too optimistic, I have been too easily persuaded by maybe certain information that have been displayed that you didn't have access to maybe before, or maybe that you didn't want to see before. I don't know, can be different in each case, but overall I feel like when you're investing in those kind of structures, I'm not naive. I am aware that people in the background, they are taking money also for themselves. It's not a non-profit organization. So the fact that there is some price markups as such is not something that shatters my world or that makes me a disbeliever of how the economy works and how business works. The question that then comes into play is there like a systematic scheme behind where they charge excessive markups to related companies that ultimately lead to investors being less protected because certain securities are either inflated, which you can't track back on the inventory, on the balance sheet, and maybe you are having less usage of the collateral as you may think you have, because the inside companies or the interrelated companies, they have taken already massive value out of those assets. They have, markups that are inflating the prices. So this is the problem that I have when it comes to, I have always known Debitum as a very transparent platform. And quick disclosure, maybe also for the ones that are wondering, Debitum and I were still in contact. We're still like discussing ways of how they can showcase those are real assets and they have been purchased with fair values, because to be fair, Debitum hasn't, or Debitum/LFDF, they haven't disclosed the purchasing contracts so far. So the timber value argument still stands as a way to explain this kind of inventory gap and also explain the purchasing contracts if those prices have been justified. So from that perspective, I don't see them as guilty as charged, but by lacking transparency and disclosing this information, you start to wonder, okay, am I as protected? And is this investment as good as I thought it was in the beginning? And then every investor maybe has to make up their own mind if they still believe that this business case with all the information that is out there right now still holds up to what they were expecting going into. And at least for me, as I have introduced in the beginning, there's like an elevated risk profile. Also in the last conversation that we had, I spoke about my kind of ability to also critically assess and analyze that I'm not an expert in everything, that I have certain limited understanding about how certain mechanism works, especially for more complex business models. And it was kind of like pointed out very nicely again with the current case on Debitum. And so there's no shame for me in taking action and saying like, look, maybe it's better off to take the foot off the gas pedal and see how things unfold and how the discussion evolve in the background, rather than to, pretend everything is good and, I trust them with my deepest heart, and like, come on, so let's be fair. But maybe you can give your view on the current
No, I think it's refreshing, because like it's probably the same for you, but I always question my financial decisions, my interpretation of information that I get to assess platforms, right? It's like it does never stop and it always evolves. I've made mistakes myself in the past. For some I paid, for some I was lucky enough to exit before shit hit the fan. And it's part of P2P lending. For Debitum specifically, based on my research, for me the risk was too high to get exposed there in the recent years. And you pointed out the remaining issue is the price for which the assets were acquired, the markups. And yeah, I'm not sure if they will release it or not. What is a little bit the strategy I'm not super fond of is, like we will not give you the transparency, but here is a cashback bonus, so investors keep transferring money. It's not something I appreciate so much, but hey, every platform does their own thing. I think from a structural point, they still depend on new financing. From my understanding is that the assets on LFDF, they are not backing the investors. So if something should go south, there is nothing like legally that investors can do. If it's worth the percentage they get for it, I don't know. Everybody can decide for themselves. My view is that if you continuously depend on new financing to grow your portfolio, it's not very sustainable. At some point, you will need to repay the principal. If at that point investors are not so keen to invest into your loans and you will not be able to refinance it, that's going to be an issue for investors. And I think this is not just an issue for Debitum. I think we are seeing more and more niche platforms in the industry who raise extreme amount of funds for above average interest rate with a higher long term and say, oh, in 2 or 3 years, we will have institutional investors, banks, they will be knocking on our doors. We will be refinancing everything very cheaply. I think the reality is very different, and investors should maybe think twice before getting exposure here. And if they get exposure here, maybe they should limit it to really such a negligible amount that they just don't care and say, I don't want to monitor anything. I don't feel like reading an article that's going to take me an hour to read and then interpret it and make my opinion on it. If they say, okay, it's not for me, which I think most investors are like that, then they should be also okay, if I lose the money, well, I lose it, and that's it.
Yeah, good perspective. And maybe to add one element in terms of handling also critical information that is shared publicly. Let's say an emerging pattern, you pointed out nicely, like, okay, we fight it with some cashback offers. What for me is even worse is the fact that, there's public allegations, there's accusations that confront your business model or that challenge your business model. And you have two ways to handle the situation. You can either go into this kind of discussion or you bail out and you remain silent. And there's like this pattern now where you see, like, as soon as there is public information, platforms are forced to kind of respond, and you see them answering, but you see, like, it doesn't resolve the entire discussion. There's questions that remain open, and instead of addressing them, they try to silence it out. They wait for whatever, it's old news, nobody will care in a week or in a month's time. And this is something where I honestly say this is not a development that I like in particular, because you have the ability to come clean, to be transparent, and this argumentation that is portrayed in the sense that we can't disclose information because of there's competitors, we don't want them to understand our margins, or like if your business, if your fund that is worth more than 50 million, that is almost exclusively funded by retail investors, and you're not able to provide a breakdown of your inventory and show a couple of purchase contracts in terms of like how much has been charged and who paid for what, sorry, but this is not enough. And investors should continue, I think, to apply pressure towards those platforms and not be satisfied by, okay, I have seen those, they have released a statement, everything is clear now. No, nothing is clear. Just like the underlying questions remain open. So why do the platforms, just because they turn to silent mode, why do investors are satisfied with those answers? Or even when I said, like, there's like the perception Debitum had, let's say the Debitum platform itself had very decent audited financials now, but it doesn't change the whole discussion surrounding LFDF. One has nothing to do with the other. So investors, I feel like when I observe certain trends, they are seeking like elements of good information that they can take as a justification. Yeah, look, they're a regulated entity. The regulator would have said anything. Or just like we've seen it with Mintos, with other cases, the regulator, they look like that those platforms act according to the regulatory standards, and that's it. But the whole business assessment, the complex business models, no regulator is going to get there and say like, look, you have charged expressive markups on this plot purchase. It's not going to happen. Investors should not be hesitant to continue to apply pressure on those platforms until they come clean, until they have shown the level of transparency that allows investors to really assess the business as a whole and say like, look, solid business, and I continue to invest. And ultimately, this is a platform-wide trend that is that can be observed, that critical information that is put out that is not responded to in a proper way, or that is not followed through in an appropriate way, that really resolves the issue at its core.
Yeah, I agree with you. So that's how it goes in the industry these days. Yeah, there are some really structural issues, and I think maybe it has something to do in the period we live in, where investors have very short time span when it comes to remembering information or evaluating information, or they just seek so much convenience that they just don't want to do anything. They're busy with their own lives, and I couldn't be bothered to read a long article with allegations and whatnot. So that's unfortunate to see, because usually if platforms go bust, the entire industry is suddenly, oh, this is a scam. All the platforms, they just frauds, Unfortunately, in this industry, you have to evaluate every platform as a standalone unit, and then you need to evaluate their risk models, business cases in the individual lenders on the platform. So it's not that simple as here is a regulated platform from Latvia who is regulated by the central bank, which means pretty much nothing because they do some checks in the beginning, but like you said, there's zero involvement in continuous monitoring of some underlying business risks. So investors also need to be aware of that. And this is also being pointed out in the prospectus for the Latvian platforms. So if people read it, they will get more educated. Yeah, it's pretty surreal for me a little bit. Like you said, that people stopped evaluating anything. It's news for 2 weeks and then it fades out. I think another problem or an argument is, then for example, Debitum, and they're like, oh, we will not share it publicly, but you can come visit us and, we can see the timber. We'll give you a nice presentation. We'll invite you for lunch. And on top of that, we had some nice payout to create a video about it. Yeah, this is also something that I think investors should evaluate critically. Perhaps you can give your thoughts on platform visits. I know we have done a few, and maybe we can share some of our conclusions and lessons or mistakes that we have learned from it.
Platform visits, yeah, done a couple of them in the previous years. I would say it can certainly, for me, it can serve as an additional layer of due diligence, in particular, understanding the people behind the business, assessing the management, the shareholders, how much know-how, how much knowledge is there actually about their business, how do they respond to a direct dialogue, one-on-one questions. And so from that perspective, it can certainly help the overall assessment. In the best case, you sometimes get access to information that is not being shared publicly. So that's obviously something that publishers can take advantage of if they are able to extract some information out. So overall, you have access to the human side of the business. And although I find value in those kind of on-site visits, for me, it's not a replacement for, let's say, a data and numbers driven analysis. And when you have factual numbers that can be evaluated, that will always be the dominant part for my personal assessment with on-site visits and, the kind of network element, meeting those people and extracting information from direct conversations. That's like a good add-on, a top-on to your overall due diligence, but it doesn't build the foundation quite naturally. So what you kind of like framed it like the portrayal of, we are on site, we are talking with the platforms directly. You can trust our conclusions that comes from those kind of visits, I would also say is limited, or it's something that can't be also discussed in an online conversation. There's, I think, no need to be on site, of course. I mean, since you picked it up with Debitum, I can also share, I don't think it will be a big surprise that Debitum or LFDF, they offered me to come and see then the plots, the timber, and have an on-site visit. And they were offering me this trip for free and saying like, look, for the travels, for accommodation. We are happy to have you here. From the basic understanding, it's a noble idea. They say like, look, there are some issues currently in the discussion. Come here, look at it yourself. You can talk to us, and that's all fair and square. I don't think that's necessarily wrong. But if you look, let's say in particular for this case of LFDF, you're talking about hundreds of Latvian purchase agreements, documents. This is something you don't assess in a day, or you come out with a conclusion, that, you're just saying like, look, I was there, thumbs up. This is all fair and square. Let's move on with our lives. This complexity doesn't allow any good assessment, I would say, if you just spend a day with them or 2 days. Those, just by the nature of assessing, analyzing those sheer hundreds and loads of documents, you probably need some AI assistance to really get a grip of the underlying story and to make a qualified judgment. So I also would encourage investors to have at least a critical look at it and not take any information that comes from those kind of on-site meetings for granted, and try to look at the numbers, not at the feelings of some other people that try to explain how the situation is on site.
Yeah, good takeaways. I can share. I've also visited a couple of platforms a couple of years ago. Last time it was Fintown, but before that, I also made a trip to the Baltics and visited a few platforms, which people can still look up the platform visits on our YouTube channel. Yeah, my take from this is that you can get some operational insights. Forget about any due diligence or any enhanced risk information that you can use or base your investment decisions on. Usually, you can spend a day, you can retrieve a lot of information from the platforms, but that information will probably be outdated in a couple of weeks because we are in a very fast pacing environment. So, it's possible that after a platform visit, you have the opinion, oh, it's good, but maybe after 6 months, it's completely trash because something has happened or that you did not anticipate. So from a trust perspective, I think personally I don't do platform visits anymore. I can do an online meeting if I have any questions or some interviews, but it takes a lot of effort and resources to arrange something, and I think the value from it is pretty limited. A critical evaluation is definitely required from an investor's point of view. And just looking at some sort of piece of content on YouTube and saying, oh, this person was there, he said or she said, it's great, so now I'm going to deploy 10K and overexpose myself to this potentially highly risky platform is not a sensible thing to do. Yeah, so about that. I think we can end this discussion on a more lighter note. I know that some investors were wondering if our families or friends also invest in P2P loans. Maybe if we give them some guidance or what's the situation looking like. So perhaps you can share how it's on your end.
Yeah, I have a couple of friends that say look, I watched your recent video, or it's been interesting insight, but I think it's mostly coming from curiosity. What is this guy actually doing? Rather than, oh, look, I really want to become now a big time investor. Yeah, there's some conversations eventually in your friend circle surrounding what you do, how everything works. And some are more following up on, hey, would you recommend this or this platform, or how do I start? Funny enough, also last year, my wife started to ask me, look, now I want to invest globally. What do you advise? What should I do? How do I start off with investing? And I told her, you can do peer-to-peer, but I would, especially when you start off, it would be a rather small position and something minor. The global focus that I advised is look for a global index fund and set up your savings plan, something you feel comfortable to, invest on a continuous basis, month by month. If you have a bit more, you can start off maybe with a one-off investment, but overall, the key to investing is always sustainability. So stick with it. And even if you make mistakes, because at one point we all gonna, make some mistakes and potentially lose some money, whatever asset class it may be, and just try to learn from it, not to be too by it, and just try to continue to learn from your mistakes and apply better lessons, better learnings than moving forward. But probably the question most people are curious about, have I recommended and also certain peer-to-peer platforms? Yes, I do. I will not disclose them in this conversation, but I can say all of them have been also part of my personal portfolio that you can see publicly. And I told her, look, this is roughly how their business model works. This is what you should be aware of upfront. And so she started off with some peer-to-peer investments as well. Maybe most investors really look at peer-to-peer as something very passive, something that they would maybe consider a buy and hold investment, which it's, for me at least, it's not. It's a very active investment. You have to really be behind the news and try to adjust your strategy and your investments accordingly. And maybe too many investors are also not too concerned about any news, because for them, it's just like, maybe it's then not worth the time. So they say, okay, look, it's just a small investment anyway. I can afford kind of to lose it in a worst case scenario. So I knew what I'm going into up front, but there's no, we're probably in a bubble, and maybe in our peer-to-peer industry, and we look at the industry on a daily basis, almost on a daily basis. So we kind of are more engaged into all the different issues that we can see on different hotspots. And for the majority of investors, it's probably not relevant information or something that they don't want to pursue, that they want to follow up. And I kind of see this very nicely with my wife, because then she's like, oh, well, you didn't tell me about this news, or is that still safe now? Or like, yeah, this is kind of the story. So overall, I have recommended peer-to-peer as an investment tool, but clearly it's, especially for beginners, it should by no means be a core pillar of your investment strategy.
Yeah, I agree with everything you just said. I have very similar conversations. My father is also investing in P2P loans, and he's like, oh, what's this? What's this platform? And what's your opinion on that? I'm like, yeah, you can just read it on P2P Empire. And he was like, no, but what's your real opinion? Oh, you're getting paid to say that. No, I was like, no, you can read it on P2P Empire, And so I have these conversations, and then I start explaining about the risks, and he zones out after 2 minutes. So in the end, I probably manage his portfolio by myself. So yeah, that's the classic. So I fully understand of people looking for convenience, and obviously those platforms offering the most convenient tools, they have the easiest time raising funds. Yeah. Yeah, I understand. And I think that's the more appealing part of P2P lending. Just as long as investors understand that there is risk involved and they can lose their funds, then I mean, it's fair game, right?
But I think, like, let's say, for instance, with Nera Capital, to get back on that topic, when you see and you imagine there's investors that have invested 61 million euro, and they are maybe now in their room asking themselves, kind of like, what have I done? What's happening? This is then the time when ultimately investors will kind of be shaken up a bit. They will wake up and ask themselves, like, okay, why have I ended up in this place? I don't know if that was ultimately for everyone a calculated risk, but I think for most investors, it's rather, as you said, it's a matter of convenience, being triggered by easy cashback, quick accessible funds, or quick accessible opportunities where you can deploy your funds. And this is then when the majority of investors kind of because for me, honestly, the Nera Capital case, just like subjective perception, I look at the peer-to-peer industry almost on a daily basis. I haven't noticed anything about Nera Capital until I read about it in the community tab, where you announced our next conversation. So I was like, it was totally a blind spot for me, because I don't really look at it. And I think most other investors don't look at it either, probably even the ones that are invested. And so this is, maybe we're just too much in a bubble, and we're just too caught on our views. But most investors, they don't really
care.
They don't really care to an extent. Yeah.
Okay. Yeah, I think we have exhausted today's topics. Yeah, if you are still here, thanks for watching. Maybe one more question. I have seen that you announced on your YouTube channel that you're stopped doing videos. So what's about that? Are you going to resume, or what should your subscribers expect? Are they gonna see you on P2P Empire in the future only, or what's the matter here?
Yeah, if they want to see me for the time being, they have to come to your channel. I always like this talking format, and I hope if there's enough interest from the investor community, I'm also happy to continue with additional episodes with you and conversations with you. Always very enjoyable. Now, in terms of my personal channel, I am currently, let's say, I don't have the resources to look at all sides of the business, and there's like different projects that I have, also some private things. The good news, peer-to-peer or Rethink peer-to-peer is definitely going to continue, but I'm currently kind of like revamping the whole blog, restructuring it, renewing all the reviews, adding new features. So it's quite time consuming. And to be fair, the video production side or the video production for YouTube, for me at least, it eats up a lot of time. There's a lot of work involved. Now I was smart enough to start also to launch a second channel. So I have a German and an English channel. So this didn't decrease my workload. And I just like temporarily paused those kind of activities until I have like added more value, more benefits for investors on my blog that still gets a good amount of traction. So I want to get this in order first, clean up the house, and then at one point for sure we'll continue then also with regular videos on YouTube. But for now, I can't foresee when this is going to happen. But at one point for sure, people are finding me on their feeds, hopefully then in the future again.
All right. Thanks for joining me today. For investors, if you have any questions or comments to today's discussion, you can drop them in the comment section below, and we'll do our best to answer them. All right. Thanks for watching, and we'll catch you maybe in the future episode again.
Thanks, Jakub. Bye for now.